Most retail traders who open their first CFD account do not fully understand what they are actually trading. That gap in understanding is where most of the early losses come from. A CFD stands for Contract for Difference. It is an agreement between you and your broker to exchange the difference in price between when you open a trade and when you close it. You are not buying a stock, a commodity, or a cryptocurrency. You are trading the price movement of that asset through a contract. The asset itself never changes hands. Here is a simple example. You open a trade on an asset priced at $100. It moves to $110. The $10 difference, multiplied by your position size, determines your result. If price moves against you instead, that difference becomes your loss. The math works in both directions. One of the main reasons traders use CFDs is the ability to trade in both directions. If you expect a market to rise, you go long. If you expect it to fall, you go short. That flexibility exists across a wide range of markets: currency pairs, stock indices, individual equities, commodities like oil and gold, and cryptocurrencies, often all from a single account. The other major feature is leverage. Leverage lets you control a larger position with a smaller amount of capital, called margin. At 30-to-1 leverage, for example, $1,000 in margin controls a $30,000 position. That amplifies potential gains, but it amplifies losses just as fast. Leverage is not a tool that forgives mistakes. It punishes them quickly. Before you place any real trade, understand the costs involved. The spread, the gap between the buy and sell price, is the most common cost. If you hold a position overnight, you may pay or receive a swap fee depending on the instrument and direction. On stock CFDs, dividend adjustments can also apply. These costs are not hidden, but many beginners ignore them until they start eating into results. Risk management is not optional with CFDs. A stop loss closes your trade automatically at a level you choose, capping how much you can lose on any single position. A take profit closes the trade when it reaches your target. These two tools should be set before you enter, not after. If you are new to CFDs, a demo account lets you practice with real market conditions and no real money at risk. Use that time to build consistency in how you plan and execute trades before you commit capital. Trading CFDs involves significant risk. Only trade with money you can genuinely afford to lose, and treat risk management as the foundation, not an afterthought.